Hello and welcome once again to the Smart Money, Dumb Money Show. I am your host, as usual, Keith Richards. I'm President and Chief Portfolio Manager of Value Trend Wealth Management, and I'm a technical analyst. And today we are going to take a look at an unknown opportunity, or at least much lesser known opportunity, that falls under the radar as far as investors who have been fixated with the whole artificial intelligence, AI, Mag 7 movement that's occurred since the beginning of 2023. So there's other opportunities that surround this, especially now with the Mag 7, at least many of them, reaching points of irrational exuberance insofar as their price performance. So AI is the real deal. It's a real movement. But when stocks become overvalued, it doesn't matter how real the deal is. A fair price is a fair price, and an unfair price is an unfair price. And you've heard me talk about this quite a lot lately. So I wanted to suggest to you a couple of opportunities that we should be watching that, again, are outside of the scope of the obvious Mag 7 and related candidates like Taiwan Semiconductor and all those candidates that benefit from AI. I wanted to look at another angle for you. And I think you will get a real kick out of what I'm going to show you today. So I'm going to bring you through a little bit of a screen share. Okay, so this is a PowerPoint I put together. And this is an opportunity that nobody's talking about, certainly not the media, because the media, as you know, my disdain for the media for so many reasons. But one of the things that the media tends to do is hype on about whatever is in the news absolutely right now. They're never forward looking. They drive with the rear view mirror only. So we want to drive with looking out the forward windshield to see what's coming. So let's take a look. Well, we know that the Mag 7, Magnificent 7, have been the AI poster boys and girls. Even some surprising ones like Amazon have been involved with that whole movement. There's a lot to do with data storage and all kinds of stuff that surrounds what AI means. And so all of these guys are either developing platforms that surround that or developing platforms to utilize artificial intelligence for various commercial and retail applications. So it's all great, and their stocks have done well for it, but now many of them are overvalued. And in fact, as this slide shows us, we're starting to see some relative underperformance. So the S&P 500 year to date, and today is March I think it's the 11th as I record this, and year to date, the S&P 500 has done 7.72%. Well, you can see that 2.3 of that 7.7, so a very large percentage of that 7.7% return was contributed to by NVIDIA. And on down the line, you can see Meta Platforms and Microsoft and Amazon. All of these stocks are part of the Mag 7, and they've been pretty big contributors. But what's interesting is the percentage of their contribution to index return is falling. So since last year, even though NVIDIA, for example, has had a 2.3% part of that 7.7% return on the market, it is losing its status as the really big contributor to performance on the index. And this is research from Bear Traps, courtesy Larry McDonald. So you can see, if you go down the line, this isn't every S&P 500 company, but you can see some of the more, let's call it value-oriented stuff like Caterpillar, Stryker, etc., are starting to become more significant insofar as the returns of the S&P 500. So clearly, if you guys did happen to read my recent blog on the rotation model that I talk about in my investment course, the online course, I noted that things like materials and energy and that kind of thing are picking up. Well, the technology and consumer discretionaries and a couple of other sectors like communications, which were in the lead, are losing steam. All right. So what's the unspoken opportunity that I am referring to when I say there's an opportunity that nobody seems to be talking about surrounding this very real change in the market and the economy, and that is AI? Well, AI and the cloud and all this stuff are heavily involved with data, and data storage is massive. And as AI becomes more and more powerful, the amount of data storage and data utilization is going to require a lot of power, and people don't realize that. So they're talking about not just electricity, but water to cool the processing units that are managing all this data storage and data utilization. So this is from Diversity Net. You can look this stuff up if you want, but these are two factors that nobody's talking about. So let's take a look at the energy forecast, because that's the one that I think that the real opportunity lies in. So if we look at the green line here, which is data centers. So if you look at this chart and data centers, you'll notice that data center energy increase is going to be accelerating at a much faster pace than many of the others, with only networks, which is really part of the whole factor as well when it comes to AI. The data centers, the energy usage, this is just energy usage, is going to increase substantially between now, so here we are 2024 and 2030. That's just 5 years. You see the difference in arc of that energy consumption. So big, this is a quote here from, again, from Bear Traps. They took it from another research piece. The data energy use was near 460 terawatt hours in 22, and they're looking at 1,000 in 2026, and this only goes to this goes out to 2030. So this is big news for us that are looking for alternatives to buying into the overbought AI sectors, and that is to look for energy sources that meet the needs of today's more green movement when it comes to energy. Well, guess what? The cheapest, most scalable, in other words, most realistically scalable into modern societies, clean energy source, most efficient for storage and transmission of that power, is nuclear. Okay, so this is really important. This is where I think a massive opportunity is lying. And in fact, if you know me and you have been following my work, I've been talking about uranium for over a year, and you can see I've been right. This is the Sprott physical uranium. It broke out. I talked about it back here, and it arced up to a very high peak. Now what's happened is that the chart of uranium has fallen back quite a bit. Well, why is it fallen back? Because I've mentioned this before. Whenever any stock gets too much over 15% past its 200-day moving average, it's starting to get overbought. And generally speaking, you won't see stocks or sectors move much past 30% before some sort of a correction. And you can see that we had a correction back in October of last year on uranium. And as it got around 28% of its index, it pulled back a little bit. But now we recently saw a 35% move over its 200-day moving average back at the beginning of this year, and uranium has fallen substantially, coming close to its 200-day. And you'll notice on this chart, once a bull market erupts, you usually do get some following of the moving average. So I can now say that uranium looks pretty cheap because it is down to about 12% of its moving average. And it could get a little lower, but not likely. There is a level of support here that looks to be broken, and that might just push it down a little bit further. But you can see there's an old level of resistance that will become support, not too much further, probably down around the $27 level from the 28 current. So I think that uranium is coming into that point where technically it's looking attractive. If we look at RSI at the bottom of this chart, it's moved from an overbought signal back here when it was way over its moving average and there to an oversold signal. So we have a lot of things going for the probability of a uranium turnaround, and the fundamentals make absolutely massive sense. And for this reason, Craig and I have traded the sector a couple of times. Now, water, not so obvious. There has been, this is the Invesco S&P Global Water Index, and it's just all the different companies are involved with water processing, water filtration, utilization, sewage, anything to do with water. And so it's not a pure way of looking at water usage, but it definitely has implications because these companies, the more water is used, there's going to be more use of their products and services, okay, purification and all that kind of thing. So if we see that there's been a breakout, which there has been, we can assume that that breakout will eventually see this index get back to its old highs. It's around 54, 55 now. The highs were around 59 to 60. So you probably have a 10% upside for the time being. It's getting a little bit overbought, but it's not overbought. It's about 10% over its 200-day moving average, but that's normal, especially after a breakout. So I think the story is good for water, especially with that breakout. I think the target is somewhat limited, but it still looks pretty good. And I think there's a fundamental case that can be made for anybody that's following this story, especially if you saw this index pull back a little bit in a market correction. It might be a good opportunity to pick it up, wash out some of that excess here, and maybe get that neckline test and then boom up to the highs. From a lower level, you'd have a little bit more, maybe a 15 to 20% move. So my choice between these two would be to look at uranium as an opportunity. Again, people aren't really thinking in terms of the opportunities that are going to come surrounding the AI movement. And so they overbought the obvious players to a point where I won't touch them, quite frankly, right now at these prices. But there's other stuff out there that I will disclose. We've been buying uranium stocks, and we don't own water stocks, but I will certainly be following that chart for a while. And I'm looking for opportunities where others are not. Again, the best investors look in their front windshield, look through their front windshield to see what's coming, and don't pay so much attention to their rearview mirror. Thanks for watching. We'll see you next week.